Good morning. Welcome to Morning Call. I'm Latha Venkatesh, back from Chennai. And with me are Sonia, Shenoy and Anuj Singhal. Well, it's clearly going to be a very important day of trade. A lot of cues that are going to break on the markets. The first of them would be State Bank of India numbers, and then of course Tata Steel and Sun Pharma numbers as well. While the other two can be considered, in a sense, State Bank of India will be considered a proxy for both the banking system and for the economy. So those numbers will be more than just State Bank impacting. Certainly PSU bank sector impacting. And then, of course, you have the GST bill in the Rajya Sabha. Perhaps the last chance in this session, if we have to see any success. Markets will not go into the event with too much expectations. But whatever the outcome is going to have a seminal impact on markets.
Well, hi Latha, welcome back. First up, we had a great time listening to all the interviews and the interactions from Chennai yesterday. But for the market itself, yesterday was not a good day. We kept facing a hurdle at that 8550 to 8600 level. Anuj, hi, morning. So before we start off trade, what are the key cues? And, especially on the global front, there are some points that you want to make?
Yes, in the first place, before up until maybe half an hour ago, my predominant thought was, has crude bottomed? And if you looked at the way in which the Indian graph plays with the crude graph and other emerging market indices, mid-March crude was at $44 and the Indian index was at 8,650 for the first time after a long gap, after that 9,000. And as you get to end May and early June, crude had gone up to $60 and the Indian index was at 7,996 on one day, but for a better part was between 8,000 and 8,200. Again, early August, crude is back at 44 and we were once again between 8,500 and 8,600. So there is a close alignment, and I wouldn't be surprised if yesterday's basket trade was a long crude short India trade. Because at that time or around that time we saw crude inching up, and yesterday crude's rally, this is of course the overnight picture, yesterday's crude rally was 2.5%. It was over $1 rise from $43 to 44.5. That's a huge rally and will have its repercussions on other markets. So that's one factor to watch. But crude's gyrations, if this is bottoming out and it eventually will move towards the $55 mark, we better watch. Then our 8,665 or 8,600 could be a cap for a longer time. If this is a one-day recovery, then it's different. But if it is really bottoming out, we have to worry. The other part is, completely overshadowing crude is the news we have got in the last half an hour from China that the currency is being devalued by 2 percentage points. And that midpoint is getting shifted lower or higher for the dollar. Now, this can have seminal consequences if it is part of a longer point, part of a longer program. At the moment, all that Chinese central bank says is that the real effective exchange rate has deviated, and therefore Chinese central bank is implementing a one-time depreciation of nearly 2%. It goes on to say that China has trade surpluses, and therefore yuan strength gives China room to adjust. Trade surpluses would mean that when the yuan depreciates, China will be able to import less and will export more. And because they have a trade surplus, they are able to execute these gyrations. They have more elbow room, so to speak. And then they have gone on to say that, this is a part of a market reform, that Chinese central bank will improve market maker quote system, that it will strengthen market-oriented reforms in the foreign exchange market, increase two-way market volatility. So they're presenting it as a forex market reform. We are moving away from administered rates, and the first thing we are doing is to increase the band of volatility. One hopes it's just that. If it's the start of greater depreciation so as to boost an economy which desperately is crying for help, then we have trouble. We already have a huge problem with steel dumping and a huge problem with tire dumping, which you are much better qualified to tell us. And people complain of even other chemicals. Those are smaller companies that are impacted and hence are not making an impact on the stock markets that much. But a further depreciation of Chinese yuan is not India positive. It is seriously India negative. And I don't think the consequences are going to be good for the Indian stock markets. The currency can weather it, but not the stock markets.
All right, so that's one macro worry that we have as we head into trade this morning. But what about the internals? Anuj, yesterday, we did see that sharp slide midday. It smelt of some sort of perhaps pre-programmed trade, as you called it. But is it a given now that, this top of 8600 to 8650 will be hard to take out unless we get one big positive trigger?
Yes, Sonia, morning. That's the sense you get. And that's the point we've been making, that at 8600 to 8650, the risk reward for fresh long positions is not in your favor, though you may still want to keep holding your existing long positions. Now, the big question this morning is normally, after every morning, after the kind of session that we had yesterday, is that was yesterday a trend reversal or a random move? As of now, you'll have to say it was a random move because, just take a look at what's happened over the last 2 weeks. July 21st, the Nifty made a high of 86.46. It fell 129 points. July 23rd, the Nifty went to high of 86.55. It had a fall of 81 points. And yesterday, Nifty went to 86.21. It had a fall of 124 points. What's common among all these three things? Every time the fall has happened, somewhere between 8600 to 8650. What's the second common point? The next morning or in 2 days, the market has reclaimed those losses.
Yes.
So as of now, I give a lot of emphasis to anecdotal evidence. As of now, the anecdotal evidence is telling you that the market trend has not changed. Yesterday was a bit of a L-good order or a basket order, because if you see a lot of stocks, Reliance, ITC, Infosys, Tata Motors, the top 4 contributors to the market decline, they all had similar trend between 3 to 330. So that's telling you that maybe yesterday was a bit of a random move. The market is lacking delivery-based buying. Yesterday, take a look at the cash market numbers from FIIs or DIIs. No commitment at all. Marginal sell number. No major selling as well, but no major buying as well. But there was quite a bit of index futures buying yesterday, about 600 crores. And I was looking at the internals. There was fresh addition of 19,000 net contracts of Nifty long futures or index futures long positions. So the sense you got was that yesterday's dip was bought, at least in the F&O market. Now the key is today's move is likely to be gap up. At least that's what the SGX Nifty is indicating. Now, will these long positions be unwound first thing in the morning when the market opens gap up, or would you want to carry forward these positions? That, I think, will decide a lot about this market texture. If today the market actually goes into the red and maybe slips below, say, 8,500 or 8,450, that changes the market trend. Till then, the market trend does not change. And one more point, while some of the small caps and mid caps are definitely in bubble territory, but the space to be in is still the mid caps and small caps. That is a space which I think is likely to outperform for some more time. Yesterday we were talking about Chennai Petro. There was so many other companies which will keep reporting good numbers. That's the place to be in. As of now, as I said, unless the Nifty gives an 84.50, this is a market which is still a buy on dips rather than sell on rally. But it's struggling to cross 86.50. It's lacking trigger to cross 86.50.
All right. Well, just one final point before we head into talking to our guests. One of the biggest cues for me this morning will be the SBI earnings. And in fact, we did see delivery-based buying of 220 crores in SBI yesterday. It outperformed all of the PSU banks. So while banks like PNB, Bank of Baroda were actually in the red, SBI closed in the green by 0.5%, and there was delivery-based buying. Now, if you remember last quarter, although the gross NPAs for the bank had fallen, the management did indicate that going ahead, slippages and stressed asset formation will be lower. So if we do get, a gross NPA below 4.25%, the indication is that the street could be relieved. Of course, the internals will be watched out for slippages, restructuring, etc. But the stock has recovered from its June lows by about 13%. So the street is factoring in at least some sort of positive news.
I'll tell you a gossip about
SBI.
this.
Sure.
Many of these results, SBI in particular, tend to leak. So I would take this delivery-based buying very seriously. But what leaks is only the P&L. And what moves the market is not the P&L. What moves the market is not even the 4.25 GNPL. What will move the market is slippages, refinanced assets, restructured assets. And that doesn't leak. So I think yesterday somebody is playing a gambit on the basis of leaked numbers. And that may not be the final number to which the market would react. So we must very much beware. Ahead of SBI, it happens with all counters. It happens with SBI as well. The numbers leak down to the decimal point, but only in terms of profit. So clearly it's not the bank's management, but somebody else which is leaking it. Otherwise they would know even the slippages numbers. Okay, on that point, let's